Good afternoon, everyone. Before we get started, a couple of housekeeping things I wanted to go over. So my name is Mandla Deskins, and I will be your moderator. A couple of housekeeping things. First, this event will be recorded. And please feel free to ask questions either in the Q&A box in the bottom center of your screen, which you can also do anonymously, or use the hand raise function, and we will make sure that your line gets unmuted so that you can ask your question. Now that we got that out the way, let's get to why we're here today. So thanks so much for joining today's Financial Transactions Taxes, Creating Revenue to Invest in America While Reducing Harmful High-Frequency Trading legislative briefing. My name is Mandla again. I am the advocacy coordinator here at Take on Wall Street, a campaign of Americans for financial reform, and I'll be the moderator. So quickly, a little bit about Take on Wall Street. Take on Wall Street is a coalition of over 50 national organizations, including community-based organizations, labor unions, consumer advocates, faith groups, and more, organized around a financial reform agenda to build a financial system that works for working families, not just Wall Street and the wealthy. A financial transactions tax, or an FTT, has long been a priority of Take on Wall Street, and of course of one of our coalition members who is the co-host of this event, Public Citizen. And it is a part of a broader effort to restructure our financial system for working people, with us being concerned of the risk of financial crash that comes with high frequency trading, which leaves working people, most acutely working people of color, to suffer most in the fallout. And also because these trades are essentially tax-free profits that provide little use to the real economy. So I'll stop there because we have a panel of great speakers to get to, and everybody didn't just join to hear from me. So let me go ahead and introduce our speakers, and then I will pass the virtual mic. So first, we have Klein, Senior Fellow at Brookings. We have Tysianna Marino, Legislative Associate at the Communications Workers of America, or CWA. Greg Jefferson, Senior Legislative Associate at the AFL-CIO, and Susan Harley, Managing Director of Public Citizens Congress Watch Division. So with that, I will pass it to Aaron. Aaron, you're still on mute.
Thank you, Mandela, and Public Citizen, and it's a pleasure to be here with other leading thinkers and scholars and advocates like Tysianna and Greg. Let me cut right to it because I know what it's like. I did 8 years on the Hill. I was chief economist on the Senate Banking, Housing, and Urban Affairs Committee. In fact, my very first day on the committee, which was March 1, 2001, was the day in which America cut its financial transactions tax. The single biggest misconception I come into in this space, and I'm going to talk off a couple, is that this is a new thing. We have a financial transactions tax. We've had it for decades. Currently, it's under 2 cents per $1,000 of stocks traded. So first fact, we've had a financial transactions tax. It's worked totally fine, right? All these the market's going to fall, the sky's going to crash. Blah. This is nothing new. All we're doing is changing the level. When I started, the level was closer to 4 cents. Today, it was the height of the dot-com bubble in 2001. The government was flush. There were these things called surpluses. I know people have heard about that as this mythical period that once occurred. People worried we were going to pay off the debt too quickly. So they cut that transaction fee. In exchange, the Securities and Exchange Commission got their staff pay raise to be on comparable with other financial regulators like the Federal Reserve. The SEC had been hemorrhaging top quality staff to bank regulators who could pay more. They got taken off the GS system. So this fee now fluctuates every 6 months to try and be about the same as the SEC's budget. It's paid on every stock trade and sale that occurs, and it works. The collection and the cost to put this thing in have already been done. What we're talking about is raising the level. And let me explain to you why it is so important to raise the level. First, it brings in a tremendous amount of money. Depending on the estimates, it's about $750 billion, $750 billion over 10 years. It is the most efficient and progressive way I know to raise large sums of money. Or if you want to use that money to balance the budget, pay for infrastructure, invest in children. I'm not going to talk about what you could use it to pay for it, but I think we can all agree that the level of revenue being brought in is deeply structurally insufficient to meet the level of current expenditures, let alone necessary investments for the future. Now, who's going to pay this $750 billion? The first thing to appreciate is it's extremely wealthy people. About 40% of the tax would be borne by households in the top 1% of income. Remarkably, more than 20% of that revenue would be paid by households in the top 1/100th of 1%. The top 1% of the top 1% pay 20% of this tax. It's incredibly targeted. I dare anybody else out there to find a tax that is that progressive. People at the median income or less, 50% of Americans from the middle to the bottom combined would pay less than 5% of the tax. Most people wouldn't have their after-tax income changed at all. Now, why is this so progressive? The amount of stock ownership in this country is so highly skewed, the statistics are almost hard to believe. 6 out of 7 Americans do not own stocks directly. Of the 1 in 7 who do, almost 2/3 make 3 or fewer transactions per year. Remember, you only pay this tax when you buy and sell. If you're a real investor who buys a stock and holds it for the long term, you're barely paying this small fee at all, only when you buy, years later when you sell, right? Only about 1 in 40 households average more than one stock trade a month. And less than 1% of all households make more than 50 trades a year. Those are very rich people, generally. 2, who's going to pay this money? High frequency traders. About half the stock trades in the country are done by computer algorithms trading on fractions of a second, trying to front run where they think markets are headed. These are not investors. These are market front runners, manipulators, algorithms, computers trying to guess where the market is going. They're not investing in a company. They're not reading about the company. They don't often even know what company stocks they bought and sold until the day closes, because the computer is all figuring it out. That is what's behind this market. These high frequency stock traders all pay this tiny, tiny, tiny tax. Raise the tax, maybe there'll be less of that high frequency stock trading. That assumption is built into the revenue forecast. So the $750 billion assumes that. You will hear a second misconception. Well, that will decrease market liquidity. Market liquidity. Let me give you some facts and then I'll give you a framework to think about it. If you eliminated all high frequency trading today, you would have the same level of stock volume as the stock market had in 2003 and 4, when markets were deeply liquid and they all worked. Liquidity refers to the ability to buy and sell transactions and how much action is occurring. But I kind of like words. And words have powerful meanings, and the idea of liquidity comes from the root liquid. So think about liquidity like you think about swimming. If you dove into a swimming pool that was empty, illiquid, you'd have a real problem. If the pool is 10 feet and you dive, it's great. Make it a 100-foot pool. Does that change your dive? You're no more. The liquidity has declining marginal value. I'm an economist at heart, like almost every other good. And these arguments high frequency traders give you that they add liquidity to the market. Take a 100-foot swimming pool, make it 105 feet. Does that change how safe it is to dive into? No. So there are not giant liquidity problems. In fact, these computer algorithms sometimes screw the market up when the computers go haywire and you get these flash crashes. I see my time is almost up. I just want to make one more final point, because there's one other giant misconception, and that's that this is going to hurt working families by reducing their pensions. You have a defined benefit. There are two types of pensions. The first is a defined benefit. That's what you guys get in the government. It's what I got from my almost 13 years of government service. It's what some lucky private sector people or public sector government employees get. Your defined benefit pension is defined. Stock market goes up, same pension. Stock market goes down. Nobody gets a bigger pension because the market went up. Market fund managers make money. Companies may have to contribute less in the future. Changing this financial transactions tax, which is changed twice a year by the SEC, has no impact on a defined benefit pension plan. Period. End of story. Oh, defined contribution plans, they'll say. Okay, maybe you buy and sell stocks. If you're investing, it's not going to make much of a difference. If you're paying money to a mutual fund or hedge fund manager who's buying and selling a lot of stocks, their fees for buying and selling will go up. Ask anybody how much the fund manager is taking out of that fund. You want to get to where that money is getting leaked out of the system from people's retirement? It's in the management fees, not in the government fees. So with that, it's my pleasure to turn it over to Tysianna and Greg, and I look forward to answering questions.
Thanks so much for all that wonderful information, Aaron. I'll pick up sort of where Aaron left off in talking about the importance of that worker component of a financial transaction tax. And so I'll talk a little bit about, why it's important for labor to support a financial transaction tax. Also talk about the importance it is to our infrastructure. And then finally, I want to speak to some of the racial inequities around stock ownership and sort of why we need to address that and how a FTT can also work to address that. So in starting at the top, why labor supports a financial transaction tax. So we support a FTT because America's working families pay way more than their fair share in taxes. That's no secret. While our current tax laws enable Wall Street traders to make millions each year without paying a single dollar in taxes on their stocks, their bonds, and their derivatives. It is no secret that our current tax code favors the wealthy at the expense of working families who pay taxes on a range of goods, from grocery stores, from groceries to clothing and everything in between. And so we believe that FTT will close those loopholes that allow Wall Street traders to avoid the kinds of taxes that working families pay every day, right? So a financial transaction tax will deter that kind of short-term speculation that creates stock market bubbles and crashes, and in doing so will hopefully encourage investors to make long-term investments that will truly generate real economic growth, which is what we want to see, which is what actually helps people, not the stock market, right? We can't rely on that for the economic growth. So why is this critical to infrastructure? So a FTT is a revenue raiser. By implementing it, we can raise much needed revenue for all of the progressive policies that are important to us, that we want to make a reality. This includes infrastructure, it includes healthcare, affordable housing, and so much more. Fortunately, these kinds of investments will also result in millions of good jobs for working families. So as we invest in things like so it allows us to invest, in things like broadband, the roads, bridges, because we can generate thousands of good paying union jobs for hardworking Americans through a tax like this. If we raise that revenue, it then allows us to redistribute that revenue and put that back into our economy, which actually helps people. It's actually what keeps families above the poverty line, right? And then there's this racial inequity component when we talk about stock ownership. So there's a deep racial wealth inequality in the United States. That's not a secret to anyone. And a financial transaction tax could play a very key role in helping to address those inequalities. So for generations, racially skewed public policy has excluded Black and Latino families and other families of color from the wealth building opportunities like stock ownership that benefit white families. So for example, in 2019, 92% of corporate equity and mutual fund value was owned by white households, while Black and Hispanic households each owned less than 2% of the total value. So when Wall Street speculation undermines good jobs and drives productive investment out of our communities, this hits our working families of color the hardest. It hits working families in general, but especially those working families of color. So with the FTT, policymakers can actually redirect those resources from short-term speculation to investments in the real economy, which will generate more revenue and more jobs for working families, regardless of race across the nation. And so that is just to begin to talk about sort of this worker component and sort of how this a financial transaction tax can actually help working families across the nation. I'll turn it over to Greg now, who can talk a bit more about that from the perspective of the AFL-CIO. So yeah, Greg.
Thank you, Tysianna. Just point of clarification, going back to Mandla's comments, that was the suffix of my name, so I don't want my coworkers thinking that I got a promotion and I'm the senior legislative representative or associate at the AFL-CIO, just a regular old legislative associate. So, but thank you, Mandla. Thank you, Aaron, for your words, and thank you, Tysianna, for your words. Thank you to Public Citizen and Americans for Financial Reform and Take on Wall Street for keeping this very important issue front and center. The AFL-CIO has been calling for a financial transaction tax for well over a decade, or as Aaron said, an increase in the financial transaction tax, because this is not new. In 2012, we used words like reckless Wall Street gambling and putting Wall Street to work rebuilding Main Street. And then in 2014, we said rein in speculation and lay the groundwork for long-term economic prosperity. Then in 2015 and 2017, we said we implore Congress to address the high frequency trading and increased market volatility it poses. Here we are now in 2021, and all these things we called for over the last decade are more relevant than ever. Wall Street still needs to be reined in. Volatility still exists in the market, and our need for investments to get Americans back to work has never been more important. A financial transaction tax would reduce incentives for Wall Street's most reckless and least valuable speculative activities, such as high frequency trading that Aaron referenced. By reducing the volume and profitability of short-term trading that serves no productive purpose, an FTT would encourage Wall Street to find new ways to make money from longer-term productive investments in companies that grow, create jobs, and develop products and services that make the U.S. competitive in a global economy. The president has done a great job of moving us closer in that direction with the introduction of his American Jobs Plan and promoting initiatives ranging from replacing lead water lines, roads and bridges, to making substantial investments in infrastructure of our care economy by creating new and better jobs for care workers that Tysianna mentioned as well. So a lot of initiatives in the American Jobs Plan. And with such a broad call for infrastructure change, the need for revenues to pay for these investments inevitably comes up. The president suggested several revenue proposals, as I'm sure you guys are well aware, and we support several of them, but notably absent was the inclusion of the financial transaction tax. And for a fee of only $0.10 per $100 traded, we would raise, as Aaron said, $752 billion over 10 years, according to the CBO and JT score. So this is a very highly progressive tax. And also, as Aaron said, Aaron, you stole a lot of my thunder. 3/4 of the revenue from a 0.1% Wall Street sales tax would come from the top 20% of society, and 40% would be paid by the top 1%. So it's a way to raise a tremendous amount of revenue while having a minimal impact on the average working people. More than a down payment to pay for these much needed investments in the Americans Jobs Plan and several initiatives moving forward. It's never been more important for us to invest in strengthening our infrastructure and competitiveness, and in creating the good paying jobs of the future. Also, as Aaron touched upon, I just would be remiss if I didn't bring up the supposed impact on our pension plans and retirement plans, since there's a lot of misinformation out there. The AFL-CIO argues that a financial transaction tax is an investment in a long-term economy that will benefit pension funds. As you are aware, the retirement fund is a pool of money that is invested in a diverse array of assets for the long term. And in order for a retirement plan to provide the benefits that are needed, it needs to be investing in an economy that can grow. There may be investment strategies that are trendy and may perform well day to day, and you may be able to make a lot of money in high frequency tradings if your money is there now and pulled out in the short term. But the problem is, if your pension fund has a small uptick in one of your portfolios, it's not useful in the long term if you're creating a downward pressure on the rest of your assets. So again, Aaron touched upon a lot of that misconception on pensions, and we would love to make sure that you guys get that information out, because that is one of the things that we hear from pushback. So I appreciate you guys joining, and we look forward to having your members hopefully continue to support us. And if they're not supporting us now, look into supporting us on including a financial transaction tax. And with that, I will turn it over to our superwoman on FTT, Susan.
Thank you, Greg. You're so kind. And thank you all for joining. I just really appreciate you taking the time today. My name is Susan Harley. I'm Managing Director of Public Citizens Congress Watch Division, and I absolutely agree with everything that's been said so far. A financial transaction tax, or an FTT, is a fantastic way to raise needed revenues in a very progressive way. Public Citizens' 500,000 members and supporters believe that corporations in Wall Street should pay their fair share. They see Wall Street raking in record profits while so many people are suffering during this pandemic, and they know that's not fair. And so Public Citizen and our allies, including Americans for Financial Reform and the others on this call, have been working together for years to implement a tax on speculation that will tamp down high-frequency trading and incentivize long-term investment. I just want to add a couple additional points on high-frequency trading. I think the point that Aaron made about exacerbating market fluctuations, we should really discuss, because it's now been 11 years since the flash crash of May 2010. And that's when the Dow Jones dropped more than 1,000 points, losing 9% of its value in just a matter of minutes. Although it quickly rebounded, it serves as a lesson why high frequency trading's liquidity is a mirage. It evaporates when it's needed most. High frequency trading also costs investors money. The tricks these computer programs use to outspeed large investors is well documented in Michael Lewis's book, Flash Boys. And researchers have put an annual price tag on this hidden cost of $5 billion globally. That's real money that's going out of the pockets of investors, but it's going directly to Wall Street instead of being reinvested in America and growing jobs. The other thing I wanted to point out is that the recent GameStop meme investment frenzy has also increased the awareness that the US could be profiting off speculation in our markets. Like a gambling tax, while an FTT would not stop the behavior outright, it may disincentivize it and will definitely increase revenues. So where are we on this topic in Congress right now? There are two bills introduced so far in the 117th Congress. One is called the Wall Street Tax Act, that's S-817, or H.R. 328. It's sponsored by Senator Schatz and Representative DeFazio. It would levy a 0.1% tax, or 10 cents out of every $100 traded, across all instruments, stocks, bonds, and derivatives. And that score, as we've heard, is $752 billion over 10 years. The other bill is called a tax on Wall Street speculation. The bill numbers are S-1283 and H.R. 2375. That's sponsored by Senator Sanders and Representative Barbara Lee. It has a differing rate. It has a rate of 0.5% on stocks, 0.1% on bonds, and then 0.005% on derivatives, and that's based on the underlying value of the derivatives. The Tax on Wall Street Speculation Act also has a low income exemption for families making $75,000 or an individual making $50,000 per year. And that legislation is estimated to generate nearly $220 billion per year. And even when you use very conservative assumptions, the tax would be estimated to raise nearly $620 billion over 10 years. The bills have a lot of similarities. It's a tax on just the purchase. There are some special rules for non-typical transactions, whereas some countries levy the tax on both the purchase and the sale. And initial issuances are exempted, as is short-term debt. I just want to emphasize that we are at a historic moment when it comes to taxes right now. The Biden plans for investments in infrastructure through the American Families Plan and the American Jobs Plan will allow for a major injection of funds into priorities like expanded education, childcare, nutrition, and green jobs. And I'm from Michigan, and that item that Greg mentioned, getting the lead out of water pipes, that just really resonates with me because of the Flint water crisis and the continuing ongoing problem that's causing for the children of the state of Michigan. And I'm just personally very happy to see a commitment to getting the lead out of the pipes of our country's drinking water systems. But all of these investments, will be needing to have some pay-fors. And so while the details of what can be done in a bipartisan manner and what will need to be done through reconciliation are still being worked out, it's clear that at least some of these investments will be paired with tax provisions that raise revenues. And as Greg noted, a public citizen like our allies, we support the policies that are already in the plan, like increasing the corporate tax rate, increasing the top rate for the wealthy, funding the IRS for additional enforcement, and other laudable policies. However, we don't want a financial transaction tax to be left off the table in congressional discussions about pay-fors. This idea has a ton of support. Both President Biden and VP Harris embraced the idea of a Wall Street tax while on the campaign trail. And it's also important to note that the Wall Street Tax Act does have that official score, that $752 billion over 10 years. That's important when you're coming to reconciliation. And we have a feeling that as the numbers are being worked out about what can be included in the bill, it might be important to have such a large dollar figure in your back pocket. So we just wanted to make sure that you all were very aware of this idea and that you were talking about it as these discussions really dig in over the next weeks. I just also want to reiterate that these taxes are not new. Not only does the United States currently have that Section 31 fee that funds the SEC, we actually had a large FTT in place from 1914 until 1965, and the rate of that tax was actually doubled during the Great Depression as a way to address the economic crisis. And around 40-ish countries right now have a financial transaction tax, including large economies like France, India, South Korea, Switzerland, the United Kingdom. Hong Kong recently announced plans to increase its 0.1% tax. That's one of those countries that's levied on both the buyer and the seller. They're increasing it to 0.13%, so a total tax of 0.26%. So obviously these work very well in other countries and are creating sources of revenue. Prominent American investors support this, including Warren Buffett, John Bogle, may rest in peace, John Ames, John Wilcox, and John Whitehead. They all signed on to the Aspen Institute's principles on overcoming short-termism, which endorsed an excise tax on trading. Former Secretary of Labor Robert Reich, former U.S. Treasury Secretary Robert Rubin, and former counselor to the U.S. Treasury Secretary Antonio Weiss, they all also support financial transaction taxes. So why haven't we seen this passed? We understand a public citizen that Wall Street and its apologists are bound and determined to block this tax. We just this week released a report documenting how the financial industry's lobbyists are pouring money into campaigns with the goal of keeping the tax from ever being implemented. 73 million total campaign contribution dollars from just those organizations that disclose having lobbyists who work on the FTT. That's combined 2018 and 2020 cycles. And when you look at those top lobbyists, the ones that have the most people working on this issue, 9 out of 10 of those organizations oppose. And they're huge lobbying behemoths that we fight every day in the progressive space. The US Chamber, for one, Also, the Securities Industry and Financial Markets Association and the Investment Company Institute. They all three top the list of the organizations with the most lobbyists working on this issue. And of the top 20 organizations with the most lobbyists working on this issue, 15 out of 20 that gave the most money oppose. So we understand that there is a ton of money in politics that's trying to keep this from playing out. There's also been a coordinated miseducation campaign where there are consultants reaching out to people, there's PR firms involved. And so this isn't just like average people speaking about this. Our members are speaking about this and saying, we want Wall Street to pay their fair share. You just need to look past Wall Street's tricks and understand that it's the financial industry trying to keep this from happening. But we can't let this Wall Street's money and politics keep this great idea from being implemented here in the United States. We think that now is the time to tax Wall Street trades. So with that, I'll wrap it up and let Mandla get to questions.
Thanks so much to Susan and all of the panelists for really giving us that overview and really detailed discussion about a financial transactions tax. I just want to wrap by saying that, as we have seen for the last year, even in the midst of the COVID-19 pandemic, where we've seen so much suffering, we've seen Wall Street profits soar. And as we discussed today, as we work to come out of the pandemic, we're at a time of great need for investments in the real economy. And as folks have said, an FTT, a progressive tax that would raise $752 billion over 10 years, is a great place to start. So we look forward to working with the offices on this call and other offices in Congress to make sure we can get this done. But to the questions. So if you have any questions, please feel free to raise your hand or put it in the question and answer. We received a couple of questions that I'll go ahead and start with that we received, and then I will kick it to whichever person on the panel wants to answer it. So the first one is something that we're probably familiar with. So this question was, working folks who make, who have 401k and IRA contributions cannot afford any taxes on their requirement. The whole purpose of these contributions is that they are made in a tax advantage manner. Would the proponents of the FTT explain to folks worried that their retirement savings would be taxed? I guess just to say, what would we explain to folks who are worried that a FTT would tax their retirement savings?
So let me jump in here, because the FTT is a giant cut in taxes for these people. And let me explain why it's a huge tax cut. When we run up deficits like what we've run up, they're paid for in the future. The future is when working people retire. And either you'll pay more in your retirement or your children will pay more. And your children are a large part of your retirement plan, whatever your 401k size may be, unless you hit the 401k jackpot. So the question isn't, are we going to raise revenue now and raise taxes now, or never raise taxes, right? This deficit ends up getting paid for somewhere. 1. 2, to the extent there's a tax advantage to putting your money in your IRA, it goes to the rich people. 40% top marginal rate means that for every dollar I put in, I get a 40% savings from Uncle Sam. A working person at a top marginal rate of 15 or 20% is getting less than half that tax benefit right now. 2. 3, buy and sell your stock. That's it. It's only a tax when you trade. Every year you hold that 401k, every year you hold that stock, there's no tax. So it's only a tax on churning, on buying and selling. People aren't day trading out of their 401ks, working people. This is the great jujitsu that folks play, is they think it's a tax on holding an asset. Oh, no, no, no. It's a tax on buying and selling the asset. And you're not churning in your 401k. If your 401k day trading in GameStop, okay. But are you investing your retirement? Or are you day trading on GameStop? I don't think that's investing.
So agree with everything Aaron said. I just wanted to also say that, you know, starting off, only about half of Americans have any stock at all, even through a 401k. And I know Aaron also mentioned like commissions and fees that are paid. I think, you know, the research has showed that as trading volume falls roughly in proportion to increases in trading costs, like an FTT, it means that for most pensions and investors, the money they pay for the tax will be offset almost in full by lower payments to the financial industry due to that reduced churn of their investment. So because those fees are so much larger, any reduced trading, they're actually like better off. We also did some research, and I believe our researcher Taylor Lincoln is on the phone, on this Zoom, and he can get into some more details regarding some of the research that he's done, if he's available.
Yep, and he has his hand raised. So Taylor, I have just put you on allow to talk. You're on mute though. Okay, now you're unmuted.
Okay, so I've sprung to life, but the light is not on, so you can't see me. Is that right?
That's right.
Okay, so Susan, what is the question specifically that I should answer?
Just talk about your research regarding cost and why average investors would not pay much at all.
Right, I think mostly it's just reiterating what Aaron said. I guess I did have a little bit of a technical question based on what Aaron said, which is that I do think 401k investors, I think if I understand it correctly, they would pay a tiny amount if they were invested based on the churn of the fund that they're invested in. But what we found is that if that is an index fund and they have a normal sized account, it's minuscule. And for an average family, average size investment, 50th percentile income, using our estimates on churn, we found that they would pay about $13 a year in the FTT. And Susan can talk later about some counter cost savings that they would receive in exchange. And then we also used numbers of oh my goodness, what is it? The American Investment. I'm forgetting the name of the organization. There are a report this week. But the industry, the ICI, the American Investment Council, and they, using their numbers, we came to a conclusion that investors would pay an average of about $39 a year in taxes from the FTT. And I mentioned that just simply because we ran our math by them, and they came back and said, we disagree with you on the proposal, but the math is right. So it's, you know, these are legit figures. They're not just things we're making up.
And I will just say Vanguard's figures have been put out there a lot. And we have an ally in Hong Kong who called them out publicly on their numbers. And so they were forced to redo their numbers. And so it's like 1/20th the cost for people invested in index funds, what they came back with. Ridiculous.
It's the Investment Council Institute. I found my footing on that one, whose numbers we used. And yeah, the Vanguard case too, for those who are advocating on it, I just think it's a really fun and very helpful situation that occurred, because Vanguard put out a report along with a bunch of other industry folks at about the same time that just used specious assumptions about what the thing would cost ordinary people. And Vanguard's assumptions were particularly egregious. And as Susan mentioned, our advocate stayed on them, and they eventually did publish a report that's a lot more credible. And like Susan said, they literally came back, I don't know what it was, if it was 6 months or 18 months, but somewhere in about a year later, they came back with an estimate. Literally it was 1/20th as much, which just shows how loose industry is willing to be with the facts to try to scare people about the FTT.
And even with that readjustment that they did, there's still these very speculative bid-ask spreads that they've included as a big portion of their cost. And so just want to caution anyone against using those numbers. And one of the things we'll send as a follow-up to this is our research that Taylor has done in this space.
Take myself off mute. Thanks, Taylor. I'm going to place you back in the participant area, but feel free to raise your hand and then we'll move you back over. Okay. So it looks like we have another question that also came through. And I think we may have answered this, but let's give it a clear shot. It says, how much would a financial transactions tax influence trading patterns?
There's a lot of different estimates on that reduction in trading volume, which is like in economic terms called elasticity. But I think the best one I've seen is sort of like a dollar per dollar reduction. But Aaron, you may have done more research in this space.
So let me parse the question slightly. The question uses the word trading, and I think there's a little bit of confusion between trading and investment. If you think a stock is a good investment, this is going to have zero effect, right? Whether you're paying 2 cents per thousand or 10 cents or $1, this has if you think a company is a long-term good investment, the marginal impact of something like this is essentially zero. If you are trying to trade on the basis of a computer algorithm that expects, based on certain front-running patterns, that a stock is going to move by 1/2 of a cent in the next 1/1,000,000th of a second, and you have a computer that's a tiny bit faster than the order coming in from California, and you can front run them and flip it, then it could have a big effect. And so what you're dealing with is this high frequency trading, which is ballooned. This wasn't a thing that existed 15 years ago. That's not investing, right? This is kind of like, it's not quite like the old, Office Space where they're skimming fractional pennies and then adding them all up. For those of us who are a little bit older, we'd call it Superman 2, but it's not quite the same, but it's a different theory. So to me, it has no impact on investment. In some ways, it actually makes investment better. The last question is, will it make market volatility better or worse, right? And let's assume for a second it had no effect. That day of GameStop would have raised $24 million in just GameStop stock. Would there have been less trading of GameStop? I don't think so. I don't think anybody on Reddit who was pushing it up or shorting it would have changed their behavior on the basis of 10 cents per $1,000, right? That's not what the play was on GameStop. And again, is that productive, functional gambling in society, or is it not? I think the better analogy are what are the taxes being put on, like the sports betting that states are starting to legalize. I know you can do it in DC on an app. That activity is also taxed.
Thanks, Aaron and Susan. And I have another question, and I wanted to actually kick this one to Greg because when you were talking about how long the AFL has been working on this and the different names, Susan touched a bit on it earlier, but we know that there are international examples of an FTT, and so given how prevalent they are, and the fact that we have a really small one now, why are we having so much trouble getting something that seems like a pretty common sense progressive tax proposal passed?
So thank you, Mandla. I guess the short answer is, as mighty as Susan and Aaron and Tysianna and I may seem, you have an industry of people who are pouring millions of dollars into preventing this from happening. And it's quite that simple. It's unfortunate because they're definitely not seeing the forest for the trees. And it's for lack of a better word, and I try not to throw this out a lot, it's greed. This is a tax where folks will still have their yachts. They will still be able to enjoy the good lifestyles that they live, but it is something that will help out millions of American workers. And just to answer your question, I think the reason why it hasn't happened is the scare tactics that we discussed earlier, with some of these same people who are holding on to their monies, are making workers and people who are less knowledgeable about this tax think that it's coming down to them. And it is imperative on us, which is one of the reasons why we're trying to have this briefing, or one of the reasons why we're having this briefing, is to get the word out to let folks know that this is a minuscule tax that could do a great amount of good. So I think that's probably the easiest way to, the best way I see to answer your question on that, Mandla.
For sure, for sure. Thank you. And then one last question, because we're getting close to time here. Let's see if anything else came through. One last question. We have quite a few staffers on this legislative briefing. And I think a good, follow-up question to kind of bring us towards the end is, what are our next steps? What are the things that we want folks to take from this, and where are we going? And I think though Take on Wall Street is actually working on this with most of the people here are actually members of the coalition, so I can answer that, but I'm gonna pause and kick it to anyone who would want to answer that. Susan, you touched a bit on the legislative side earlier, so if you wanted to take that one.
Absolutely. So the next step is for decisions to be made regarding sort of how many packages, when they will move, whether it will be bipartisan or not, whether it will be done through reconciliation, if so, how much, what are the top lines. So all the decisions have yet to be made. I think all we know is there's a commitment from the Biden administration to invest in infrastructure, families, jobs, to regrow our country as we are coming out of this like horrific thing that we've all been dealing with, this pandemic. And so the next steps are, for the tax committees to come together to determine what sort of policies they include for pay for. So we'll be having more in-depth conversations with folks on those committees. But really what we need are people to join these bills, the two bills that I mentioned, as co-sponsors, to show the increased support to the momentum continues to grow in these issues, and we need more members of Congress to join these bills. And then we'll see where we go as far as the legislation being worked out through reconciliation. But I don't know if Ty or others want to jump in.
I just want to add everything that Susan said, but also say, I think light pressure on the administration would be great. By hands down, this has probably been one of the more pro-labor administrations we've seen in maybe ever, at least since maybe FDR, or but it's great pro-labor administration. Nonetheless, I think some pressure on the administration, since the president and the vice president has supported a version of this, and having your members remind the administration and the Treasury officials and the folks who will be responsible for moving this, that this is a viable pot of money that's out there, that I think if you look at the polling and you look at what our Americans are saying on what they agree as far as taxation, I think this polls well, and that they won't be out on a limb asking the administration to strongly consider this. Sorry, Ty.
If I could just,
Yeah.
Ty.
Oh, I'll just go really quickly. Nothing really new to add, just to echo what folks are already saying. Working people know that they understand what's going on. They understand that, the wealthy profit in ways that they don't, and they see that it is unfair. And I think that this is the time, as Susan and Greg both touched on, this is the time to really get loud about an issue like this. We are in a prime time where we have an administration that is ready and willing to work with us on these issues. And so we have to be very intentional about being loud about that and about positioning it as something that really will raise revenue that can help everyday Americans, because they're not benefiting from this in the same way that that wealthy 1% is, or that wealthy 1/10 of the 1% is. And so I just would echo my siblings here in saying that now is the time to get really loud and to use the fire and the fuel that we have, because folks know what's happening, and it's time to amplify their stories and get them sort of the economic justice that they deserve. But Aaron, I'll turn it back over to you.
I was just going to echo Susan's point. I've worked on infrastructure bills. I worked on the Safety Act in 2005. And what infrastructure really needs is long-term, dedicated, stable funding. We set up these trust funds, and the trust funds are set up. And that's one of the reasons why they're almost always funded with a very specific tax or fee: gas tax, harbor maintenance tax, airport tax, right? And that gives us stability. These transactions tax are pretty darn stable. Yes, trading volume fluctuates from year to year, as witnessed by what the SEC is, but we have so does gas tax, by the way. That fluctuates a lot. A lot of people, less driving in 2020 than anybody in the world had predicted. So this is a fantastically stable pot of money. It is paid for and easily collected by an already existing system. Somebody asked kind of why this hasn't been done. I think it has to do with how progressive it is. When the top 1% of the top 1%, 0.0001 of the population is paying 20% of the revenue, there you go. That's a lot of money to come out of people, out of billionaires' pockets. And there's a reason they would much rather have it on the gas tax or other things, right, that are distributed very differently. So I think there's a logic to putting it in for infrastructure. And if you think about it, America, infrastructure is an investment or bet on America. Corporations are giant winners from investing in our infrastructure system. And so if you take this money and then invest it in America, we're going to all be wealthier in the long run, including the investors who make that commitment.
Thank you. Looks like we are running up on time, and I don't think we had any other questions. So I just wanted to thank everyone for joining us today. And with that, we are going to promise to be in touch, and we're going to close out. So thank you all.
Thank you.
Bye. Thank you.
Thank you.
All right.